Good morning and welcome back to the Daily Hunt for Multibaggers on this Wednesday, June 3rd, 2026. We're here to dig into all the market chatter and AI-generated insights from yesterday, June 2nd.
That's right, Ethan. Our systems were certainly busy. We saw a really high volume of social media discussions yesterday, flagging quite a few different stocks. The overall market sentiment we observed was definitely mixed, leaning towards promising for some areas, but with a strong undercurrent of risk for others.
Absolutely, a lot to unpack. Let's jump right in. First up, we're looking at SanDisk Corporation, SNDK. Now, the community sentiment here was a bit neutral, mostly reflecting on its past strong performance. But looking at the fundamentals, I'm seeing exceptionally high operating and net profit margins. Over 69% for operating margin alone. That shows incredible efficiency. Plus, insider buying and overwhelmingly positive news painting SNDK as an undervalued blue chip in the AI memory space. This stock has seen a dramatic 10x run in the last year, and analysts are still calling for big upside. It feels like it could continue to grow into its valuation.
Well, Ethan, while that past performance is impressive and those margins are undeniably robust, let's remember a neutral community sentiment isn't a strong forward indicator. The price-to-earnings ratio is quite high at 58.82, and price-to-book is 24.87, suggesting a lot of future growth is already priced in. Our AI analysis notes a moderate revenue growth of 2.51%. While the news is positive, we need to ensure this isn't just hype. This stock was rated stay away just yesterday. I think, despite the bullish outlook, those valuation metrics warrant caution.
I hear you, but with those margins and insider confidence, I think it's got strong legs. Based on the potential for continued strong performance, I'd say we're upgrading this one. Final verdict? Buy.
Next, we have SELLAS Life Sciences Group, SLS. The community is buzzing, very bullish on its upcoming REGAL trial results, with some users anticipating a massive $10 to $12 billion buyout. That's certainly a speculative target.
Yeah, the user sentiment is genuinely enthusiastic, with a biomedicine professor giving an 80% success chance. Insider buying is also strong, showing internal confidence. Jim Cramer even called it a great spec. If this trial goes through, this stock could be a true multibagger, significantly exceeding its current $1.6 billion market cap.
Hold on, Ethan. Those are huge ifs. The key performance indicators tell a different story. SLS currently has negative earnings per share and a zero net profit margin. It's a pre-revenue biotech, meaning its entire valuation is based on a single binary trial outcome. The beta is extremely high at 2.244, confirming it's highly volatile. A price-to-book of over 14 suggests significant future success is already priced in. While there's undeniable community optimism and insider buying, a narrow miss on that trial, or even just meeting expectations without exceeding them, could lead to a massive correction. This stock was previously a speculative gamble and stay away. I'm seeing no reason to change that high-risk assessment. Final verdict, stay away.
All right, let's move to Hyperliquid Strategies, Inc., PURR. This one has a truly unique value proposition in the crypto space, acting as Hyperliquid's treasury. Users are calling it uncorrelated to the broader crypto market, citing phenomenal revenue generation with 99% going into token buybacks and burns. Insider buying is strong here too, with 8.04% net shares purchased. It's trading near its 52-week high, validating this bullish momentum, and analysts are even predicting a GME-style gamma squeeze.
Ethan, the strong insider buying and operating margin of 73.8% are certainly impressive, especially in a volatile sector. However, the net profit margin is 0%. While the buyback and burn strategy is intriguing, it still means the company isn't holding traditional net profit. The GME-style gamma squeeze is a speculative prediction, not a fundamental indicator. It's an unrated stock for us, so we need to be cautious about jumping into something this new and potentially volatile.
While the 0% net profit margin could be a red flag normally, the buyback and burn strategy explained by users is a direct value add to the treasury, which is PURR. The momentum and insider conviction are too strong to ignore. This is a first-time rating for us. Final verdict? Buy.
Next up, Micron Technology, MU. The community sentiment is quite mixed here. We saw posts celebrating massive gains and declaring MU is not going to stop, but also a lot of cautionary tales and users suggesting it's 2 years too late for new entries in the AI shovel plays. Many joked about how their purchase would crash the stock after its insane run.
Yeah, MU has certainly been an AI darling. Its role as a critical HBM supplier is undeniable, and news articles are overwhelmingly positive, highlighting its AI shift driving a $1 trillion rise and even 70% upside potential from some analysts. It's trading near its 52-week high after a near 10x surge in a year. That's incredible growth, reflecting its crucial position in the AI infrastructure.
But Ethan, that 10x surge also means its price-to-earnings ratio is over 50 and price-to-book is over 16. That's very stretched, and the debt-to-equity ratio is extremely high at almost 15. What concerns me most is the significant insider selling over the last 6 months. Those closest to the company are taking profits. This stock has frequently bounced between buy, cautious buy, and stay away, but the recent insider selling and extreme valuation suggests significant risk. Final verdict, stay away. Let's turn to API Group. Now, the social media discussion here was largely about using APIs for a stock tracking system, not the company API Group itself, so we don't have direct user sentiment. Exactly, which means we're relying solely on the KPIs, and those are concerning. We're looking at an extremely high debt-to-equity ratio of over 16, negative operating margins, and negative return on assets. While revenue growth is 13.5%, it's not translating to profitability. Despite a low price to book, a PE of 58.44 with negative operating profits is a major disconnect. This stock was previously rated stay away. Final verdict, stay away.
Moving on to Wind and T Offshore, WTI. The community is very bullish on oil, citing an unpriced supply disruption from the Strait of Hormuz and rapidly depleting inventories. Users are long on oil, and news confirms persistent geopolitical instability driving prices. While the company itself is currently unprofitable with negative net profit margin and EPS, the bullish thesis is that oil prices are poised for a parabolic increase, which would directly turn these metrics around. Plus, insiders have been buying 1.84% net shares, signaling confidence.
Ethan, while the macro argument for oil is compelling, WTI's current financial state is precarious with negative profitability and a negative price-to-book ratio. That means its liabilities exceed its assets, which is a serious red flag. The stock has risen from $1.50 to $4.02 in a year, which shows momentum, but it's still fundamentally weak. A buy here is purely a bet on the macro thesis, ignoring the current financial health. This has been a stay away or speculative gamble previously. I agree it's risky, Brooke, but the insider buying and the strong macro thesis, directly supported by news, indicates a potential turnaround. If oil prices surge as predicted, this company stands to benefit immensely. This is an upgrade from its previous stay away and speculative gamble ratings. Final verdict, buy.
Next up, Palo Alto Networks, PANW. After their Q3 earnings, the sentiment was overwhelmingly bullish. Users were celebrating massive gains, with some reporting 70–100% increases. The company beat revenue and earnings estimates, driven by soaring demand for cybersecurity, especially with AI adoption. Analysts like Jefferies are still bullish, and the stock is trading near its 52-week high.
Ethan, while the post-earnings enthusiasm is clear and the company's performance is strong in the cybersecurity space, the valuation metrics are a major concern. The price-to-earnings ratio is an astronomical 256.19, and the PE ratio is over 5. These are extremely high multiples, meaning the stock is priced for perfection with virtually no room for error. The debt-to-equity ratio is also quite high at almost 5. This is its first rating from us, and while the growth is there, the valuation is simply too stretched. Final verdict, stay away. Moving on to CrowdStrike, CRW. The sentiment was mixed, leaning slightly bearish for new investors. While the company is an AI shovel in security, many users felt it was 2 years too late to get in for lightning-fast gains.
I think that's too cautious, Brooke. JP Morgan just adjusted their price target to $800 from $475, maintaining an overweight rating. That's a huge vote of confidence. Plus, they're expanding partnerships to secure enterprise AI systems. Revenue growth is a robust 23.3%, and insiders have been net buyers of over 94,000 shares. This stock is trading near its 52-week high, signaling strong market trust in its continued growth story.
Ethan, despite that impressive revenue growth, CRW is still unprofitable on a net basis, with negative net profit margins and EPS. The price to book is nearly 44, and the PE ratio is over 6. These are excessively high valuation multiples for a company not yet generating net profits. The debt to equity is also high at over 18. While the insider buying is a positive and their partnerships look promising, the current price already reflects an enormous amount of future growth. Previously rated speculative gamble and stay away. The current valuation simply screams risk. Final verdict, stay away.
Now, Intel, INTC. There's some intriguing data here.
One social media discussion highlighted a Trump investment signal monitor that previously flagged INTC as benefiting from a government stake secured in March 2026, leading to a significant stock jump. This model predicts 10 to 30% upside in weeks. Intel is expanding its AI infrastructure and launching new AI products, and insiders are net buyers of over 600,000 shares. This indicates potential for strong future performance and, some powerful catalysts.
Ethan, that Trump tracker is an interesting concept, but it's not a fundamental analysis. The actual KPIs show major red flags. Negative net profit margin and EPS, meaning the company is unprofitable. The debt-to-equity ratio is extremely high at over 36. While new AI products are promising, they haven't translated into profitability yet. The stock has also recently dropped from 124 to 107, indicating downward pressure. Intel was previously rated cautious buy and even buy, but the financial health has deteriorated too much. Final verdict, stay away. Let's talk about AMC Entertainment, AMC. The community mentioned it in historical meme stock discussions, but provided no forward-looking sentiment. Our AI analysis shows some very recent positive news: record May attendance and stronger EBITDA, leading to a stock surge.
Exactly. Record attendance since 2019, driven by blockbuster movies. And get this, insiders have purchased almost 5 million shares in the last 6 months, representing over 76% of total insider holdings with no sales. That's a massive vote of confidence from those who know the company best. That sort of insider action suggests a significant turnaround potential.
Ethan, I can't ignore the fundamentals. The net profit margin is negative, the earnings per share is negative, and most critically, the price-to-book ratio is deeply negative at negative 0.65. That means the company has negative shareholder equity. Its liabilities exceed its assets. While recent news and insider buying show some positive momentum, the underlying financial structure is severely distressed. The stock has also seen a year-long decline, despite recent bounces. Previously rated stay away, and unfortunately it still is. Final verdict, stay away. Up next, Palantir Technologies, PLTR. The community sentiment here leaned neutral to slightly bearish, classifying it more as an application layer in AI rather than core infrastructure, and noting that software lags hardware. Many comments also suggested it was too late for easy gains. I think people are missing the bigger picture. Palantir has strong AI infrastructure momentum, attracting significant investor attention. Jim Cramer has a positive take on it, and it has impressive revenue growth of 84.7% and a net profit margin of nearly 44%. That's phenomenal profitability for a tech company. It's clear they're making money from the AI boom. While that revenue growth and net profit margin are strong, Ethan, the valuation is extreme. A PE ratio of 172.92, a price-to-book of 43.17, and a PE ratio of 2.24 scream overvaluation. This means an immense amount of future success is already priced in. What's more, insiders have been net sellers of over 2.1 million shares in the last 6 months. That insider selling, combined with the stretched valuation, makes it incredibly risky for new entries, despite the AI narrative. It's consistently been a stay away for us. Final verdict, stay away.
And finally, NVIDIA, NVDA. The community sentiment, while acknowledging huge past gains, was moderately bullish. Some users felt it was too late for new lightning growth, but others insisted, no such thing as too late, my boy. Best time is today.
That too late sentiment is important, Ethan, but let's look at the numbers. While the current price is near its 52-week high, the PE ratio is incredibly low at 0.69, suggesting it might still be undervalued relative to its expected earnings growth. Revenue growth is an astonishing 85.2%, and the net profit margin is a whopping 62.97%. These are outstanding metrics. Exactly, and the news is overwhelmingly positive. New chips for PCs, expanding AI platforms, positive analyst forecasts from Bank of America, and immense insider buying of over 58 million shares. This company is not only dominating, but still innovating and growing at an incredible pace. Despite being rated stay away just yesterday, this is a clear upgrade. Final verdict, buy. All right, Brooke, let's quickly round up today's candidates based on our AI-generated insights. Investigate as buy. SanDisk Corporation, SNDK, Hyperlick Strategies Inc., PURR, YNT Offshore Inc., WTI, NVIDIA Corporation, NVDA.
And that wraps up another episode of the Daily Hunt for Multibaggers.
Just a quick reminder for all our listeners. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions.
We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for joining us.
We'll be back tomorrow with more market insights. Happy hunting!